at the Federal Reserve Bank of Dallas, and I'm really excited to see all of you here with us this evening, both those who are joining us in person and the many people who are also joining us online. This is our first Global Perspectives event for 2026, and one of the largest we have ever held here at the bank. So Governor Miran, thank you for drawing such an amazing crowd. It's wonderful to have you and to see so many people. Our Global Perspective series was introduced in 2016 to bring our community into the bank, to share our research, and to hear directly from thought leaders in academia, businesses, and policy on the economy. If this is your first time with us here at the Dallas Fed, or your first time getting to know us online, thank you for joining us, and I hope you have the opportunity to meet with some of our leaders this evening. And I don't want to get ahead of myself, but I hope to see you again for one of our upcoming events. Our goal at the Dallas Fed is to build a strong economy together. And to do that, we need to have a deep understanding of the economy and how everyone is experiencing it. One way we do that is through events like tonight, where we hear from experts in their field on key topics related to the economy. And we promote conversation through audience participation, so I hope you sent in some questions before this evening. That dialogue of two-way communication is really important and an important part of how we serve you. The Dallas Fed represents the 11th Federal Reserve District, which consists of Texas, northern Louisiana, and southern New Mexico, and we are one of 12 regional banks in the nation, and along with the Board of Governors in Washington, make up the Federal Reserve System, our nation's central bank. The 12 regional reserve banks serve as local operational arms of the Federal Reserve System, providing on-the-ground economic insights, supervising member banks to support their safety and their soundness, and processing payments to ensure the economy functions smoothly all across regions of the United States. And the 12 Reserve Bank presidents and 7 governors at the board make up the Federal Open Market Committee, which is responsible for carrying out monetary policy to pursue our dual mandate objectives of price stability and maximum employment. Relative to other public institutions, the Federal Reserve has 2 aspects of its structure that are unique and crucial for how we serve you. First, we're not one centralized organization, but rather a federated system with deep local roots. This structure was intentional to allow the Federal Reserve to build deep roots across the country and to promote public trust in the Fed and in our work by bringing perspectives from all across the country into the policy conversation rather than concentrating that power in Washington, D.C. And second, in our monetary policy responsibilities, the Fed operates independently while remaining accountable to the public through elected officials and our local boards of directors. Although a large part of our work is done through a unified approach to best serve our nation, we have to set the same interest rate here in Texas as we do in Tennessee. And in bank supervision, we can't be any more or less stringent when we examine banks in San Antonio than we do when they're in Seattle. But our regional structure and its local roots ensures that reserve banks represent the public's voice, your voice, in all of those national decisions. I'm really proud of our team here at the Dallas Fed and how we gather your insights. Our network of branches in Houston, San Antonio, and El Paso gives us a strong foundation to reach communities throughout our region. I regularly engage with business and community leaders across our district, many of whom are with us this evening. Now, last month, I had the chance of visiting leaders and students in Denton, Texas, and I heard how manufacturing, an early indicator of economic activity and growth, is picking up. And earlier this week, I had the opportunity to see firsthand how AI and robotic technology is developing through tours of innovation-centered organizations in Austin, and I saw some amazing robots you just would not believe. We also gather information systemically through our surveys, which over 1,000 business and banking executives in the region respond to ahead of every single FOMC meeting. These surveys also help us identify turning points in the economy before they're visible in the actual official data and shed light on the reasons behind these shifts. And I hope those of you who lead businesses and banks who are with us this evening are already responding to our surveys. But if you're not, I hope after this evening you go on our website and become one of our regular participants. I regularly share those anecdotes that I hear from all of you with colleagues at the FOMC table, such as how job seekers are navigating the job market and how business owners are responding to shifts in national policies with issues around immigration, tariffs, or deregulatory initiatives. This is because, in my view, hearing multiple perspectives, including your perspectives, promotes better decision making. In my experience, the Fed's data-driven approach to monetary policy and the regional representation around the FOMC table enables us to make thoughtful, objective, technical decisions while keeping the public interest at the center of all we do. So I'm really excited to have one of my colleagues with us this evening to share his views. For the last several months, I've had the privilege of working alongside Federal Reserve Governor Stephen Miran on the FOMC, and it's really my pleasure to introduce him to you all tonight as our featured speaker. Governor Miran took office as a member of the Board of Governors in September of last year, and prior to his appointment, he served as chairman of the Council of Economic Advisors at the White House. Previously, he was a senior strategist at Hudson Bay Capital Management, a senior fellow at the Manhattan Institute for Policy Research, and served as senior advisor for economic policy at the U.S. Department of Treasury from 2020 to 2021. I think this event also marks his first time in the 11th District in his official capacity, and I'll say he's visiting one of the first reserve banks of the 12, and he picked the best to get started, of course. But we really thank you for being here. Moderating today's conversation is Tom Falk, retired chairman and CEO of Kimberly-Clark. I'm really grateful for Tom's service to the bank. He served as a member of the Dallas Fed Board of Directors from 2019 through 2024 and served as chairman his final 3 years. Throughout his career and in his retirement, Tom and his wife Karen, who is also with us this evening, have shown continuous commitment to making North Texas a better place through their philanthropic efforts to invest in the next generation of leaders. And on a personal note, Tom co-led the presidential search that brought me here to the Dallas Fed and to Texas, and for that, I will always be grateful. So please join me in welcoming Tom Falk and Governor Miran to me.
Thank you. Thank you. Good evening. You guys all look pretty serious out there in the crowd. You think we're going to talk about economics or something like that. So thank you, Lori, for the wonderful introduction. As I've told others, I think the thing I'm most proud of in my service to the Dallas Fed was that I was the one who helped hire Lori and brought her to Dallas. So thank you so much, Lori. So Stephen, you got a great background. You know, you've been successful in government, academia, and the private sector, and it's increasingly rare that you find individuals that work in all three of those spaces. Usually, people wind up, getting involved in one, and they don't move around. Can you talk a little bit about those experiences and how they've shaped your views as you joined the Federal Reserve Board as a governor?
Sure. So first of all, let me echo the gratitude to Lori for organizing this event and for that all too kind introduction. It's great to be here, and it's great to see all of you guys. Thank you. I guess one interesting thing about my background, relative to some traditional backgrounds for a seat like this, is that I've worked for most of my career in financial markets, and the corner of financial markets that I come from was macro investing, and so. And if you're doing a macro investment thesis, you kind of have to disagree with what's priced into the market. So you sort of have to think that everyone else might not be right about something. And so it comes as no surprise that I have no problem taking an out of consensus view. Yeah. Part of that comes from my background in financial markets, where if you don't have a disagreement, there's nothing to do. You may as well just sit on your hands. The other thing that I think comes from it is I try and be very flexible in my thought process and be willing to change my mind. About what's driving the economy or what's driving inflation or unemployment or financial markets. Because when there's new information, or the information you get rejects your earlier hypothesis, you have to be very flexible, and you have to be willing to change your mind when confronted with a reality that rejects the framework you were previously using. So I try and do that a lot, and I think that that career that I had before coming into government service helps me to I think both not be embarrassed by being out of consensus, but also be willing to change my mind when confronted with new information.
Yeah, and I would say on a regional bank level, that was one of the things that I found most interesting. I mean, there were a number of Fed board meetings that I came to, and I was pretty sure I knew what the right thing to do was. And after listening to the economists make their presentations, hearing from my fellow board members, hearing from the president, I came away saying, you know what, I might not be 100% right. There's probably more than one way to do that. Is that essentially what you're seeing and finding at times?
Absolutely, and I think it's important to listen to a variety of views. I want to hear all views and constantly interrogate my position, because if you don't do that, you become complacent.
Yeah. Well, let's dive into the economy. So everybody, I think, is here. How many people care about the U.S. economy in the crowd today? Okay, that's why you're all here, right? So what's your outlook? We were upstairs. We were chatting for a few minutes before, and you seem pretty bullish. What's your view of the U.S. economy right now?
Sure. I guess so. When I got to the Federal Reserve in September, I had a view that there was some weaker growth in the first half of last year because of some uncertainty around sort of the restructuring of the global trade system, as well around the potential for the biggest tax hike in history. Both of those elements got resolved last year, and so I expected growth to be a bit better as things moved forward. Then, towards the end of last year, we got a series of data points that indicated things were weakening, and I started to get more concerned about that view on the economy going forward. And I would say the last couple of data points have actually been a little bit better and alleviated some of that concern, but not all of that concern. I still see some pockets of slack in the labor market that can be accommodated by monetary policy, but some of the concern that I had is certainly a little bit less than it was. And I think going forward, I think there's a series of supply-driven changes in the economy that are going to be supporting economic growth. I see things being driven by the very powerful deregulatory agenda, which I gave a speech on in January. I see things being driven by AI, although I find it difficult to quantify. I can definitely start to see the effects. And I see things being driven by the investment incentives from the One Big Beautiful Bill Act that I think are quite powerful, and certainly evidence from the Tax Cuts and Jobs Act of 2017 was that the full expensing provisions were the most powerful parts of that in terms of incentivizing investment. So I see a series of policies that push out the supply side of the economy, which I think will be underwriting economic growth in a non-inflationary way.
Well, that's good. I think everybody here would love to hear that, right? What do you think are the biggest risks to growth? If you said, what could get in the way? Where are there problems that might, if we don't get it right, might trip us up?
You're looking at it.
Yeah. There's no mirror here, Stephen. So I thought, oh no,
it's us. I think it's us. I've argued that I think that there were a variety of circumstances So there's something in economics, in monetary policy, called the neutral rate of policy, which basically means you're not hitting the gas or you're not hitting the brakes. Monetary policy is neither restrictive nor expansionary. And I think
it's called R star, right?
Yeah, it's called R star.
I had a bet with the economists that I could get R star into a question, and they weren't sure I knew what R star was. So I think I win the bet. So
you got it.
Yeah,
you got it.
yeah,
You said R star first, so you get the prize.
Yeah.
And I think there's a variety of factors that have pushed that around more quickly, I think, than I think consensus has given credit for. And some of those factors are things like the very high population growth that we had in previous years, followed by now very low population growth. Some of those things are changes in net national borrowing driven by swings in fiscal deficits and declining deficits that I'm a little bit optimistic about in the future. And I think what that has done has led monetary policy to passively tighten in the last year as neutral rates came down. If policy rates don't come down by the same amount, then they become passively tighter.
Yeah.
There's another element that worries me, which is that I think folks may be thinking about about the stance of monetary policy in a little bit of a wrong way, or a way that I don't agree with, because typically you think about the stance of monetary policy as being related to the real interest rate. The real interest rate it determines investment decisions because you don't get, if prices are going up because of inflation, you don't get the return on that. You get the real rate of return on investments, and so that's why you look at real rates x inflation to evaluate the stance of monetary policy. But of course, the inflation rate that you choose matters. And if you're measuring a rate of inflation that doesn't have anything to do with returns, you are looking at a real interest rate that's not a real interest rate of return. And so, for example, if we are mismeasuring inflation because we are misconstruing portfolio management fees, which is something that I've dwelled on. That index in the PCE inflation index basically just tracks the stock market and conflates a quantity with a price. I think a lot of people in this room probably know that fees have been in trend deflation for 2 decades instead of extraordinary inflation. That series has contributed 36 basis points to core PCE in the last year versus historic norms of 6. So that's a bias in inflation that is not a return that anybody gets. So if you subtract that inflation rate off of the nominal interest rate, you're not looking at a real rate of return that anybody gets. And so I think that I think that some people think that policy is less accommodated than it is, that don't realize just how restrictive it is. Similarly, if you think that tariffs are driving inflation, and this isn't my view, but it's the view of a lot of my colleagues, if you think that tariffs are driving inflation, that's not income that anybody gets because the government gets it. And so if you have tariffs built into your inflation outlook and you subtract that measure of inflation off of the nominal interest rate, you're looking at a real interest rate that is biased by using the wrong inflation measure. Nobody is getting that real rate of return, and so monetary policy is not as accommodative as you think it is. So the biggest risk, I think, to the economy is that we're misconstruing just how tight monetary policy is.
Yeah, speaking with PCE, by the way, everybody know what PCE is in the audience? It's a measure of inflation that the Fed uses. We hear CPI a lot in the popular press, but PCE is really what you guys use as a more reliable indicator. Is that fair?
Well, it's what the Federal Reserve has chosen to target.
Yeah, the 2%.
Yeah.
And one of the audience submitted questions asked about owner equivalent rent and the weighting of that. Is that overstating inflation? So in that measure, they don't know what it costs if you own your house. So they put in a factor called owner equivalent rent. And it's a calculation, and it's inherently not accurate, but do you have a view on that or a perspective?
Yeah, I do. I mean, look, the problem with inflation is that it's a sausage that has to get made. And, I can tell you the price of a pound of coffee or a barrel of oil or an AI GPU. But inflation is the change in the general price level, and the general price level is an abstraction. It's not concrete. It doesn't exist. It's got to be constructed by government statisticians who have a very, very challenging task in front of them. And there's 1,000 methodological choices they have to make with no clear right answer. And so as such, it's very difficult to conceptualize exactly what inflation means. How you incorporate housing is a very complicated question. So complicated, for instance, that if you look at the way that the European Union calculates their inflation measures, they don't include owner equivalent rent at all because they couldn't agree on how to calculate it. That's how contentious these issues are. So what owner equivalent rent does is it basically says if you own a home and you rented out your home, you'd be able to get some income for that. And so by occupying your home, you're essentially consuming that amount. And so we're going to count the housing consumption that you do by imagining that you're consuming the rental income you theoretically could get for your home. Of course, there's no really perfect way of doing that. We do our best. I think the Bureau of Labor Statistics does its best. I think they do a good job, all things considered, but there's still some issues. And one of the issues with housing is not, in my mind, is not actually OER. I think OER generally is a good thing to do. It's the fact that housing inflation is really, really backward looking. And so the way that the government statistics agencies measure housing inflation is to look at rents, which then feed into rents people pay, as well as owner equivalent rent that we just discussed. But they look at rents for all people. And that makes sense because you would care about consumption of all people and prices faced by all people, as opposed to just rents on new leases, right? And the reason this matters is most people don't renew their lease every day. They renew their lease once a year, once every 2 years. And so as a result, if you don't renew your lease for a year, whatever the rent's in the market right now, you look at Zillow or something, that's not the rent that you pay. You don't actually experience the rent increase until you renew your lease in a month, 6 months, a year, whatever it is. So for that reason, because there's a lag in when the lease is reset, the way that we measure shelter inflation lags by a significant amount what you see in market rents on Zillow or anywhere else you're looking at market rents. Now, it's a little bit more complicated than that, but the bottom line of what's going on in the way that we measure shelter inflation is that it reflects, because of these really substantial lags that are built in the current circumstance, it reflects the housing market of 3 or 4 years ago. It doesn't reflect the housing market of today. And shelter inflation is printing materially above where it was before the pandemic because of this lagged issue, because it reflects the housing market of 3 years ago. Meanwhile, market rents have been running very low, around 1% for a couple of years now. And so there's various statistical reasons that I went into in a speech in December on the inflation outlook to expect measured inflation rents to converge down to market rents, I think pretty reasonably quickly over the course of the next year. So I do think that there are some biases built in from this. I'm optimistic that they will start to normalize over the last year, but this is just another way in which I think that the inflation data are somewhat different than inflation as would be indicated by supply-demand balances in the real world.
This kind of leads into the next question. At the most recent FOMC meeting in January, you preferred to lower the rate by a quarter point. The decision was to keep rates where they were at. You've dissented other times, and others on the FOMC dissent from time to time. Can you comment on what led you to that recommendation, and what data would you need to see to come up with a different view? Or what data are you looking at that drives your view?
Sure. So there's 2 elements to that. Well, actually, I guess there's 3 elements to that. The first one is inflation. As I was just saying, I view the measured inflation data that we're getting as distorted by a couple of anomalous factors right now. There's always biases in the way that you measure inflation. The problem is if those biases change over time. If the biases change over time, you're implicitly adjusting your inflation target. And the 2 biases that I just mentioned, shelter and portfolio management fees, are contributing much more to inflation than they historically would have. Those biases are bigger than they used to be. And therefore, my view is that underlying inflation, looking through those biases, is actually very close to our target. If you don't look through those biases, you are implicitly moving your inflation target down. So that's one reason. Another reason is the labor market. Sort of at the end of last year, there were some signs of stress in the labor market. The last couple of prints have been a little bit better than we got at the end of last year. But nevertheless, there are some remaining signs of slack in the labor market that are of interest to me, of the type that I think monetary policy could accommodate. And these are types of folks who are working part-time for economic reasons, longer periods of time spent unemployed, some folks who are marginally attached to the labor force. I think there's some space for monetary policy to help create jobs for those people and pull people into the labor force. And then lastly is the question of what economists call the output gap. And so, as you're aware, economists have supply and demand, and if supply increases by more than demand, you have what we call an output gap. That's slack in the economy, unused resources that could be put to use by some monetary stimulus. And as we started off discussing before, I view the supply side of the economy as having been pushed out by a variety of factors like AI, like deregulation, like capital deepening. And these are factors that create slack in the economy. And it doesn't matter whether that slack emerges because demand goes down while supply stays here, that's a recession, right? Or demand stays here and supply moves up. And that's what I'm talking about with the productivity shocks, right? It's still slack in the economy, increased potential output that can be accommodated by looser monetary policy. And so the combination of these things leads me to think that monetary policy is tighter than it needs to be, and that we can afford to have lower interest rates.
So if you saw weaker job market, that might change your view, or hotter inflation data, that might change your view, or what are you thinking about there?
Yeah, so what would change my view? So my view is predicated on the fact that I don't think that we have an inflation problem. I think that we had a big run-up in prices, and prices are now roughly stable at a higher level than they used to be, right? So there's a difference between affordability and inflation. But right now, I see prices as roughly stable, unlike, say, 4 or 5 years ago when they were not stable. So I view price stability as having been restored, albeit at a higher level that people are understandably unhappy with. Now, a lot of my view is based on the housing market, is based on the fact that market rents have been growing at a 1% rate for 2 years, that lease renewals have caught up in level terms to new leases, which means that there's now a cap on how much a landlord can charge when you renew your lease. If the outside option, if you're gonna move homes and the new lease in a different home is up here, your landlord can increase your lease a lot. It's a lot of inflation, right? If the renewal lease is caught up to the outside market, to the what you would pay if you moved homes, the landlord can't really increase your lease as much. He's capped by what you would pay if you moved outside, right? The fact that the renewal leases have now caught up to the new leases means that there's going to be a lot of deceleration in the rate of increase of renewal leases, right? So a lot of my inflation view is built on the housing market. What would make me think my inflation view is wrong? It would be seeing stories about how rents are going to accelerate, about how rents are picking up, right? You do start to see some signs of the rental market stopping going down, right?
Yeah.
But we haven't yet seen signs of rents really picking up. And because rents have been growing at such a low rate for 2 years now, it makes me very optimistic about the convergence of measured shelter inflation down to where the market has been for 2 years.
Maybe talk a little bit about the dissent process. I think the group might find that interesting. I was chairman of Kimberly-Clark for many, many years. When we had a board meeting, usually we talked until I got everybody to vote yes. So, you know, I knew they all wanted to eat lunch and go home. So, you know, most boards are unanimous. And in the Dallas Fed, we had several meetings where there was not agreement. We would have a vote before our president goes to an FOMC meeting, and we'd have a spirited debate, and not everybody agreed, and that was okay. And it's sort of a unique thing, I think, and maybe you can comment about the dissent process. I mean, when you dissent, does nobody talk to you at break, or how does that all work? I mean, is it...
Yeah, they talk to me at break. I don't know why. It's some failing of judgment on their part, so they bother talking to me.
Yeah.
But they talk to me, and everybody's very friendly. And I think people appreciate that I have that I have economic reasonings for why I do what I do.
Yeah.
I don't just make things up. I lay out fully the economics of why I believe what I believe. And I think it's all pretty standard economics. I don't think anything that I've invoked is very avant-garde or cutting edge. And because of the extent to which my views are out of consensus, I have felt it important not only to lay out my economic reasoning, but also to lay out a lot of my calculations, which I think is a pretty unprecedented step of transparency. Anybody can sort of take a look at my speeches and find calculations in them, and I tell you exactly what we would call the elasticity. How big is the economic effect, right, relative to how much the thing has changed, and argue with me and say, hey, I think that you've chosen an estimate from the literature that doesn't apply in this case. It's too high. It's too low. And so we think that your calculation's too high or too low. I try and fully lay out my justifications for why I think what I think, and I hope that people appreciate that.
Yeah, well, I don't think these people have had enough to drink to take them through the math of that, but
the night's young.
But I would say one of the things that has struck me over the years is that as people dissent, I mean, you're all looking at a lot of the same facts, but people legitimately interpret them differently, and there's a respect for having a different view and a willingness to listen and admit that you might not be right, and I think that's a unique strength of the system. I don't know if you would agree with that.
Yeah, I think it is a strength of the system, and as I said before, I think it's important to have conflicting views. I think it's very easy to fall into a complacent groupthink if everybody's on the same page all the time, and so I think it's important to air those differences.
So let's talk about the labor market just for a minute. You talked about it a bit, and I'd love to get a U-Star reference in here as well for the economists in the crowd. The neutral rate of unemployment. These guys they're really impressed tonight, I think. But we saw some massive revisions in labor data this week. The number of jobs created in 2024 was reduced by 1.5 million, and the number last year was almost 400,000. And I know that's not not your data source, but how do you view that? I mean, is it different than we thought, or is just it was the same and the data are catching up?
It is different than we thought. I am more focused on the future because monetary policy works with a lag.
True.
If we adjusted interest rates today, it wouldn't fully hit the economy for 12 to 18 months. Therefore, you need to make a forecast for 12 to 18 months out and think about where the economy is going to be 12 to 18 months from now and make policy for then. This is a problem, in my view, with data dependence, right? If you're data dependent, you're making policy based on what happened 6 to 12 months ago, or even longer, depending on the data series. In the case of shelter inflation 4 years ago, not where the economy is going to be a year to a year and a half out. And so if you're excessively data dependent, you're excessively backward looking and you're guaranteeing that you're going to be behind the curve. So looking forward, we've now had several years of these large negative benchmark revisions. So something has, clearly become a little funky in the data process. I think it makes sense to assume that you'll have similar on a that there's a reasonably high chance of similar on a go-forward basis. And it underlines for me that it's right to be concerned about monetary policy being too tight and right to be concerned about the health of the labor market on a go-forward basis.
Yeah. So we were at a dinner at the Fed a few months ago, and one of the speakers went around and he said, okay, which are you more worried about, inflation or unemployment? As you think about that as a policymaker today going forward, which one or aren't you very worried about either one of them?
So I'm not worried about, unless I see an uptick, a very strong uptick in the rental market, in housing markets. If I see housing markets coming roaring back and we're sort of talking about people, bidding wars on rents again, the way we were, then I'm going to be very worried about inflation. Very, very worried.
So not worried about inflation and labor force or unemployment? How does the dual mandate of the Fed is to optimize both of those? How do you feel about? Are you worried about unemployment or job trends, or not really?
As long as I can continue expecting that shelter inflation over the course of the next year is going to start coming in below where it was pre-COVID, pre-pandemic, and I'm no longer alone in this expectation. I think the other folks are gradually, there's a handful of people gradually coming in this direction. But as long as that continues to be my expectation, I have a hard time being concerned about inflation because really, really low shelter inflation can compensate for more inflation in other parts of the index. As long as I remain unconcerned about inflation, I think it makes sense to continue trying to underwrite the labor market with looser monetary policy, particularly as supply expands more than demand and the economy can grow without generating inflation. You hear an expression a lot where people accuse policymakers of wanting to run it hot. That metaphor is sorely lacking because it misses the fact that you are changing the engine. And if you're going 60 miles an hour with a 10 horsepower car, you're running it hot. If you're going 60 miles an hour with a 300 horsepower car, you're not running it hot. The car can handle that, right?
Yeah.
And so if you're taking steps to make the supply side of the economy respond more dynamically, then you're increasing the horsepower of the economy. In the same way that we saw after the pandemic, various problems in supply chains constrained the supply side of the economy, reducing the horsepower, meaning that a certain level of economic growth was running it hot. Now, if you're taking steps to expand the supply side because of AI or deregulation or capital deepening through investment incentives, whatever it is, then you're increasing the horsepower of the engine, and a certain growth rate is no longer running it hot. The economy can accommodate that. So if supply is growing to meet demand, you can have high growth without inflation.
So do you have a view of the neutral rate of unemployment? We're at like 4.5-ish, I think. At what level would you be concerned?
I think the natural rate of unemployment is probably around 4%.
Yeah.
So I think we're somewhat above that at let's say 4.3 to 4.4% based on where it was versus where I expect it to be.
Yeah.
And as such, I think that there is some slack in the labor market that, as I said before, can be accommodated.
All right, let's shift gears. Let's move to another hot topic: tariffs. So when you were at the Council of Economic Advisors, you advised on some tariff policies. Now that you're in your central banker role, and you've heard all kinds of stories about tariffs are going to cause inflation,
All
or
kinds.
tariffs are not going to cause inflation. Some of the companies I've been involved with, they had some effect. They were able to pass some of it along in pricing. Some were unable to and found other ways. It's sort of been a mixed bag. And so what's your view of tariffs from a monetary policy standpoint? Is it affecting inflation and the broader economy or not?
Sure. So I was always a seller of the idea that tariffs were going to have really enormous negative consequences for the economy for a couple of reasons. One of them is what economists call the theory of tax incidence. And so it's a basic
theory
of tax incidence,
Tax
which is a
incidence.
question of who bears the burden of a policy, whether it's a tax, a subsidy, a regulation, no matter what it is. And it's a really basic result in public finance. And the basic result is that whoever's more inflexible ends up bearing the burden of a tax because the person who's more flexible adjusts his or her behavior. And I think the easiest way to see this is in real estate markets. Imagine you're looking to buy a home and the town you're looking in jacks up taxes on the home by 50 grand. You might say, I don't want to pay the extra 50 grand on the house. I'm going to look one town over, 3 miles down the road, still close to work, family, friends, but they didn't just jack up the taxes by 50 grand a year. So you're going to look in the town next door, the guy who's selling the house is stuck. Your demand can move across borders. The house is stuck in place. It does not move across borders. It's immobile. It's inflexible. The house absorbs the burden of the tax. The selling price goes down, and the incidence is borne by the seller. So the question is, who's flexible, who's inflexible? I always believe, for a variety of reasons, the U.S. is more flexible in terms of its ability to allocate demand across border. Factories are stuck in place. Workforces are stuck in place. They can't move. And therefore, sellers would ultimately bear the burden of the tax. That's one reason I expected tariffs not to have a big consequence for the economy. It's revenue paid for in part, the burden of which is borne in large part, I believe, by the exporting nation. The second reason I expected tariffs not to have a significant consequence for the economy is because the U.S. international sector just isn't that big. Imports are like 12% of GDP. So in order to have a really substantial consequence for the economy, you need to have a really huge swing in that to really get sort of profound growth or even inflation consequences. When you look at the international trade literature, trade economists tend to estimate that the overall gains from trade, so the trade that we have versus a world of no trade whatsoever, total isolation, is on the order of 5% of GDP, right? And give or take a few percent, could be 2, could be 8, but generally 5% is ballpark for what the trade literature estimates. And at the end of the day, that's just not that big, right? So the economics literature estimates that the gains from trade are actually surprisingly small in my view. And therefore, it would push, it strains credibility for me to believe that from the swings that we've seen, there would be enormous economic consequences. Now, that wouldn't be true for a small open economy, right? If you're a small island, trade's going to be a lot more important to you than if you're the United States of America. So it varies from country to country. Now, I'm still of the view that we haven't seen material tariff effects in inflation, and I draw this conclusion from two analyses. One is comparing U.S. Imported core goods versus overall core goods. You would expect, if tariffs were a big driver of inflation, that imported core goods would be inflating materially faster than overall, right? Imports faster than domestically produced goods. You'd expect to be able to pick that out of a lineup, and I can't when I look at that analysis. And the other analysis that I do is to compare U.S. core goods versus core goods in other countries. Again, I would expect, if tariffs were a material driver of inflation, I'd be able to look at a chart with no labels and say that's obviously the United States, and I can't do that. The U.S. core goods is in the middle of the pack. So I don't really see tariffs as driving a lot of inflation. I'm open to changing my mind if the data come in different on those two analyses. And if that happens, I will very flexibly change my mind and say I do now see some tariff inflation. So I don't have a really good explanation for why there's been higher inflation in core goods than we had, say, pre-COVID, other than to say that there's a couple possibilities. One is that we've just been having this bullwhip cycle where goods boomerang around. That's happened multiple times since the pandemic. Another one is that there's a lot of trends that predate tariffs that have to do with supply chain resilience. If you think back to the pandemic, we were having all these shortages of medical gear and these supply chain snarls, and there was an increase in chips. There was an increasing focus on supply chain resilience. There's been proliferating export controls all around the world, and that's only reinforced emphasis on supply chain resilience really across the world, which might help explain why the US doesn't stick out from other countries. But those both predate tariffs, and a lot of the analyses that pick up tariffs, I think, also pick up those effects. And so I think that those trends have been in place for a while, and I think it's improper to conclude that all of the increase in core goods is from tariffs when those effects have also been in play have been in play for a while. I think it's a problematic economic conclusion that has also led to some problematic political optics for the Federal Reserve.
So let's move from tariffs to the fiscal situation. So the Fed does monetary policy. Everybody knows that, right? Congress and others do fiscal policy. But how does the U.S. fiscal situation of large budget deficits, rapidly growing public debt, and debt service costs affect monetary policy? I'm on the Lockheed Martin board, and I think for the first time this year, the interest on the federal debt will exceed the defense budget, for the moment anyway.
That was last year, I think.
Last year, yeah.
That was FY24, I think.
Yeah,
So a couple
yeah.
of years
So
ago.
think about how does that amount of deficit and debt affect monetary policy in any way, if at all?
Sure. So it affects monetary policy through a couple of ways. Through a few ways. One is, what is the demand? If the government expenditures go up or down, or tax burdens go up or down,
Crowds
it can affect
demand.
it can affect what people spend in the economy.
Yeah.
Another is it affects supply. Government policies affect economic decisions. A tax is a disincentive to work, and so if you increase taxes, you're disincentivizing work. You're incentivizing, leisure, non-work, or home production. And so those are efficiency effects on the supply side you can change the amount of labor supply that people are willing to provide by changing the return on working through the tax code. And then finally, there's what we call the neutral rate. We mentioned R-star, we mentioned before, the rate that's neither hitting the brakes nor the gas, right? And the way it affects the neutral rate is through through what economists call the supply-demand balance for loanable funds. If net national borrowing goes up, if you're borrowing a lot in the economy, it will raise the neutral rate. And if net national borrowing goes down, it will reduce the neutral rate. And so if you have lots and lots and lots of savings, the neutral rate goes down. If you have lots and lots and lots of borrowing, the neutral rate goes up.
Makes sense.
And you see this internationally. You see this domestically as well. And when you look at the financial accounts in the United States, you see that the household sector and the corporate sector are generally in small net financial surplus, and those only really swing around by huge amounts if you have a recession. And the fiscal balance is a pretty big deficit, and it's offset by lending from the rest of the world. Those are the four components of the financial accounts of the U.S., right? And if the government balance is swinging around, then you're changing the net national borrowing, net national savings balance. And so if the fiscal deficit declines, as I expect it to, that serves to reduce the neutral interest rate, which is one of the things that has fed into, in my view, the reduction of the interest rate that's been occurring over the last year and making monetary policy passively tighter.
We were talking earlier, and you had a more optimistic view than probably I'd heard about the outlook for fiscal deficits. So the combination of GDP growth, productivity, some tariff income, maybe lower interest borrowing costs. Could you talk just a little bit more about that and how we might think about that?
Sure. So so I'm more optimistic on the deficit than I was say a year or 2 years ago, and for the following reasons. One is that I expect tariffs to bring in almost $400 billion a year. That a little bit below that, but that
In that range, yeah.
neighborhood. I also and that's obviously reduces the primary deficit. I also expect better economic growth from a variety of the supply side features that we were discussing before. I think people are gradually starting to increase their estimates of potential growth in the economy. And I think that they will, just as I think people have been moving in my direction on tariffs over gradually, very slowly over time, I think they will also continue having to increase their estimates of potential growth in the United States. But a good rule of thumb from the Office of Management and Budget staff is that a 1 percentage point increase in GDP growth will also raise government revenues by about $400 billion a year, because when the economy is growing really strongly, revenues grow faster than outlays. When the economy goes into a recession, outlays grow faster than revenues. So if you have 1% better GDP growth, you get another $400 billion a year. I think probably it's safe to assume, probably for me, I assume that I think we're probably going to get maybe 3/4 of a point of better GDP growth, which will then deliver more revenues and reduce the deficit. So those two combined will reduce the primary deficit by a lot. On top of that, I see the low inflation in the pipeline and the reduced borrowing needs from the primary deficit will reduce the interest expenses and thereby reduce the interest burden too. And so I think probably there's some significant savings there as well. So, for me, it's plausible that we could get, somewhere between 2 and 3 points of deficit reduction from these three things over the medium term. And so you're talking about bringing a deficit that's running from 6 to 7% down to, let's say 3, 4,
4.
yeah, something like that.
Yeah.
In an economy that's growing, 5% nominal. And so, then you've got the deficit below the rate of GDP growth, and that's a declining debt to GDP ratio.
Yeah.
And so, for this to work, you need a couple of things. You need the tariff revenue to realize, and you need the potential growth to realize. And I'm optimistic on both of those fronts.
Yeah. I mean, that's interesting. It's an interesting perspective. We're not alone in the world economy, and so let's shift gears and talk about China. So I saw something recently where China said they would love to become the world reserve currency, in addition to the U.S. dollar. So what are the implications for the U.S. of that? How important is it that we be a reserve currency, and what do we have to do to continue to earn that right?
Yeah, so I think being a reserve currency is an enormous asset for the United States. And I gave a speech last year in which I underlined that the United States should remain the reserve currency forever. And people didn't seem to take that message, but I underlined it on purpose. We should remain the reserve currency forever. I'm not really worried about that. So a reserve currency has to be deliverable. You have to be able to get it. And if you have capital controls, you can't let your currency out, or else you break the capital controls. So I'm not really worried about the scenario you described. Moreover, I think two things. I think one, as I just said, I think that the fiscal outlook is getting better in the medium term, which will underline the strength of U.S. financial markets and help preserve that status. I also think U.S. economic growth is going to continue pulling away from the rest of the world in economic growth because of all the reasons we've been talking about potential growth increasing. I think we're doing, I think the policy changes that have taken place, I think AI, all of these things are going to contribute materially towards economic growth in the medium term. And in the medium and the long term, what really matters for capital is economic growth. Money always follows economic opportunities. And if the United States economic growth is pulling away, it's really hard for me to imagine a world in which capital is. If U.S. economic growth is pulling away from the rest of the world to the upside, it's really hard for me to imagine capital flows not following that.
Yeah,
that's just
strong
basic.
magnetic pull there.
That's just basic investing. Money follows growth. So if you have the combination of an improving fiscal outlook combined with U.S. economic growth outperformance, therefore increasing the United States share of global GDP. That to me is a story of dramatically reinforcing U.S. reserve status. So that's not something that worries me at all.
That's good. That's a good story, I think. What, you guys excited about that? Everybody, all right. So let's shift gears and talk about what's going on in your neighborhood. I'm sure most people have heard that there's going to be a new Fed chair coming up. So Kevin Warsh has been nominated. There's going to be a new sheriff in town. So what advice would you what one piece of advice would you give to Kevin coming into this role?
That's a tough one.
No one here will tell Kevin that you said it. So you're
I'm not
just
sure anyone
among
should be
friends,
taking
so.
advice from me.
Yeah.
You know, I'd go back to what I said before.
Yeah.
Be forward-looking, not backward-looking. If you're going to be excessively backward-looking, you're guaranteed to be behind the curve. And I think there's times to be data-dependent, and that's when you really don't have good reasons for having confidence in your forecast. If you think uncertainty is extraordinarily high, and you really can't make heads or tails of a forecast, then you've got no choice but to act on the data and be backward looking. But if you've got a good forecast and you believe in your forecast, as I do, because we know the market rents, right? The market rents have been 1% for 2 years. Those are mechanically, arithmetically, a window into the future of shelter inflation. We know that. That's just a statistical, arithmetic, fact. And if you have a reasonably good forecast, then you should be forecast dependent
Bless you.
and forward. Bless you. And be forward-looking, not backward-looking. The time for data dependence is when you have really not much when you have enormous uncertainty. I don't think we have enormous uncertainty. Arguably there was a lot more uncertainty, let's say a year ago, than there is now. There was a lot more uncertainty during COVID. There was a lot more uncertainty in the aftermath of the global financial crisis. This is nothing like that. This is the time to be forecast dependent, not data dependent.
All right, so let's go micro on the Fed. So I've been on the Dallas Fed Board of Governors, and I've appreciated how this system works. I mean, this system was created in 1913, right? So how many things that were created in 1913 are still working exactly as designed? And so to have a system that's balanced between the center and the regions, I think is amazing. But what do you think about it, or how do you see this policy working and helping the Fed make better decisions on monetary policy?
Well, as I said, I think having a diversity of views is really important, and I think that the federated nature of the Fed system, as President Logan was describing before, is really one of its greatest strengths. And I think having a fusion of economists and business contacts, and business people and market participants, I think that's incredibly powerful. You want to have a diversity of views. You want to challenge yourself. You want to interrogate your own position. You want to check it for weaknesses. Because if you don't, you'll just be complacent and you'll end up being wrong for longer. There's never any shame in being wrong. There's only shame in remaining wrong. And if the more information you get, the more diverse viewpoints you get, the more quickly you'll be able to change your mind, because you're encountering information and ideas that will challenge what you think and help you arrive at a more robust position.
All right, we're about to get the hook, but I'm going to ask for, can I have one more question? So I learned a valuable lesson when I was on the Dallas Fed board. I thought the Fed was sort of all owned by the Fed, but actually the community banks own the regional banks. And the 11th district has more community banks than any other district in the country. And it makes a huge difference. They lend to small businesses, and if you go to a community that doesn't have a good community bank, you see a different place than if you go to one that does. And so I just wondered, they're under threat from regulation and complexity and competing with all the big banks. And how do you view community banks, the importance of it in the system, and what's your vision of the implications if we have far fewer of them in the future?
So I think community banks are incredibly important, and part of this goes back to the economic theoretical foundations of capitalism, right? Local knowledge matters, and what price, one of the the Nobel Prize that went to Friedrich Hayek, right? Was for understanding that price mechanisms work to communicate information through the economy, because prices, when demand goes up, the price goes up and draws resources to where it needs to be. If there's a shortage of ice, the price of ice goes up and draws ice to where it's in short supply.
This is cold ice.
Yes, cold ice. So it's so nobody can really have no centralized planner can have that local knowledge, and so it's the price mechanism that helps allocate resources. And I think community banks play a very important similar role because local knowledge is really critical to making sure that you can evaluate the creditworthiness and needs of borrowers. And if you have community banks that really know their communities, then they have that local knowledge that helps them get credit to where it's needed. If everything is overly centralized, you're losing the ability of having that local knowledge that can help credit get to all the parts of the country that it needs to get. So I think community roles play a critical role in the extension of credit into the economy and thereby in economic growth.
And just for everyone's knowledge, on every one of the Fed district bank, there are 3 A directors that are community bankers from their region. And I would just say they bring very deep insights on what's actually happening on the ground in their market. So they're a very valuable part of the discussion. And with that, Madam President, may we turn the floor back to you for some concluding remarks. Thank you, Governor.
Thank you.
Yeah, thank you.
Thank you, Governor Miran, for the excellent discussion, and thank you, Tom, for the moderation. I think you got R star, you got U star, but I didn't hear Pi star. So I'm not sure you got all 3 of them this evening. What an incredible conversation. Thank you all for that. As I mentioned earlier in my remarks, this series originated as an opportunity to bring the community into the bank to hear our research and to create dialogue. I'm excited. I hope you'll join us on your seats this evening. You should have seen the events for the rest of 2026. And I hope you'll join us March 26th for Vice Chair Jefferson, who will be here. And I have to say that right after that in May, one of our directors, Hunter Hunt, who's with us this evening, will be joining me for conversation for another global perspective. So please join us for these other events. On the flip side of the card is the information to the surveys. And again, for those business leaders or bankers who do not participate in the survey, I hope you will take this and join us. And for all of you who are on social media, I hope you might share this information about our surveys to those that you know so that we can continue to get the most important data collected for our district and bring that information to the FOMC. I just again wanted to thank you. I had one more thing I wanted to do this evening. Is Donald Bowers here? So let me just introduce Donald Bowers for all of you in the room. Donald is our regional executive for North Texas. So if you don't know us, if this is your first time with us, I hope you'll come say hello to Donald and get connected with us so we can make sure to take opportunities to invite you to roundtables, to bring you in for events. And so I hope you'll say a word of welcome and meet Donald. So thank you all again for joining us this evening. What an incredible evening, and I hope to see you again in March.
Thank you. That's a great job.
Thank you.
Yeah.